Well, ladies and gentlemen, Greg Michalowski. Today's end-of-day report for the Forex for June 26, 2014. My email is gregmichalowski at gregmikefx.com. You can also find me on Twitter at gregmikefx. Today, we had some fundamental news come out of the UK. Bank of England's Carney and the Financial Policy Committee introduced a couple measures to limit riskier mortgages and also to prevent excessive consumer debt buildup. One was to limit the proportion of mortgages at 4.5 times income to no more than 50% of the new home loans. The second one was that banks must decline loans to borrowers who fail a stress test that assumes an immediate 3% increase in a benchmark rate. So rates go up by 3% tomorrow. If you fail a stress test, no loan. So those are the measures that went into place. Initially, the pound sterling went to the upside. Why? Because the thought is that if they're incorporating these types of measures to slow the economy down, they're also thinking about raising rates as well. So that is the thinking behind the whole thing. Other economic fundamental influences today, or at least the economic data that came out here today in the New York session, U.S. initial claims came in pretty much as expected. Consumer spending was a little weaker than expected. Might have hurt the dollar a little bit. U.S. personal income rose by 0.4. PCE deflator year on year came in as expected for both the headline and the core. And Fed's buller was generally more hawkish, expecting a rate rise by the first quarter of 2015, expected growth. The rest of the year, 3%, expected inflation to move toward the 2% target. But Bullard is not a voting member on the FOMC, and as Adam Button says, he's been talking about higher inflation now since 2008 next year, and every time the inflation doesn't quite get there. So those are the influences that we've seen in the market and trading here today. So let's take a look at some of the technicals here as we head into the new trading day. The euro versus US dollar actually came off rather nicely here today. Fell below this trend line here. This trend line connected a bunch of different highs going back to May 19th, high here on June 6th, high here on June 19th. Fell below that level right here after trying to hold the level yesterday. Toward late yesterday's trade, moved back below that level, went below the 100, went below the 38.2, went below the 200, even got below this double support level against trend line, also against the 50% retracement level, and the low from, I guess, a couple days ago as well. So it fell through that, but that was it. The market then moved back above the trend line, back above the 50% retracement. If I zoom in here, you can see here how the market held that level at the 135.81 level, and then it was to the upside here for the rest of the day. Taking a look at the 5-minute chart, kind of ran out of steam here when the market started to move back above the 200-hour moving average, moved back above this trend line, 38.2% retracement, and moved all the way up toward the 200 bar moving average on the 5-minute chart. We're starting a new trading day in between the 100 and 200 bar moving average, here represented by the green bar and the blue bar. And either the market's going to, we'll look for a break to the upside, or traders can look for a break to the upside or to the downside here. Typically when the price trades in between the 100 and 200 bar moving average, it's unsure of which direction it wants to go, so we're looking for a break either to the upside or the downside. It's as easy as that. Let's take a look at the pound versus US dollar. As mentioned, this currency pair was influenced by the Bank of England decision to limit mortgages. The initial move was to the upside. The market high came in at the 170.38 level. You need to go to the weekly chart to understand why that market stalled near that level. And you go back to this day right here, back in August of 2009. What was the high price? 170.41. What was the high price in today's trading? 170.38.7. So we got within about 2.5 pips or so of the 41 level. Now we went above that level in last week's trading, not once, about twice, and this week we went above it on Monday's trading. But on Monday, couldn't get an hourly bar close above that level, and the market came down about 100 pips from that level. And today we went up there and tested it and fell off. Now where do we fall off to? And that is to another technical support level down below. This was defined by not the by the 200-hour moving average, and also the 50% retracement of the move up from yesterday's low to high. That midpoint level came in right at that 200-hour moving average, and the market moved above it and stayed above it for the rest of the trading day. We ended up on the day. We will see if that market momentum can take it, or the market move back to the upside here, can take it above the 170.41 level, or do we find sellers up there against that level in overnight trading? That will be the key here. If you're more bearish on the pound sterling, or you just want to sell against a stop above it against a 41 level, thinking that the market will have a difficult time getting above that level, and maybe you can sell up here and buy down here. That's always an option. Risk can be defined and limited against those levels on the downside. If the market's going to go lower, guess what? Where we need to get below? We need to get below the 50% retracement level, also the 200-hour moving average on the downside. It's as simple as that. So support down here, resistance up here, and we're looking for a break either to the upside or the downside for those two currency pairs. Close but no cigar. The dollar versus the yen tried to close below the 200-day moving average for the first time since this day, going back to October 24, 2013. Had one day closed below that level. The next day opened and went lower, only to have the market close above it, and it was Katie bar the door to the upside from that point right there. That took the price up from about the 97 level all the way up to the 105 level, about 800 pips to the upside. Now we've been consolidating over here and allows a 200-hour or 200-day moving average to catch up with the price. Yesterday we tested it, today we fell below it, and as you can see, we came right down to this trend line connecting a low to a low to a low. I'll zoom in here just to show you. There we go, came right down to that line. The market moved above that level. Closed above the 200-day moving average. 200-day moving average in the new trading day comes in at 101.64. A move below that level would be more bearish, and the market's going to be looking for further selling, further momentum to the downside. Maybe get below this low right here at the 101.42. Corresponds with these lows right here. Only, I guess, one or two closes below that 42 level here and here in the month of May. So it's a somewhat significant level there at the 42 level. Get below that level, and could be open the door for a further test or another test of the low for the year, which came in at the par 74.8 level. Let's call it par 75. This low came in at par 81, just 6 pips above that level, so that would be another target on the downside for the dollar versus yen. Looking at the hourly chart, the market is finding some resistance. I'm going to zoom in here and show you what the resistance is against this topside trend line. We have 1, 2, now 3 different points along that topside trend line, which is going to be of significance in the new day. It comes in around the 71 level. It's only 4 or so pips away from that level. Not much of a range here, but the market has that. If it moves above the 71, 72, 73 level, should see higher prices. That's what it looks like on a 5-minute chart. Kind of went down, couldn't stay below the 38.2 to 50% retracement. Move between the goalposts here. Try to move to the upside, and late trading back down in between the goalposts is defined by the 100 and 200 bar moving average, and that's what we're looking at for that. The Aussie versus U.S. dollar. We been in this consolidation here on the daily chart. Tried to the downside, couldn't go. Moved back to the upside, couldn't go any higher than or couldn't get above the high for the year here, and rotated to the downside. We've been up and down the last couple of days. Have been very narrow trading range. One was down low where we found support. The next today was just very sideways here. Staying above the 100-hour moving average, giving it a little bit more of a bullish bias here at let's call it the 94 level, 94 even level. Stay above the 94 even level and things look okay. Move below the 94 even level and then below the 93.87 level. Of course, both of those are very possible. We could see the price rotate back down toward another test of the 10 line at the 93.66, 67 level, and moving to the upside there. On the top side, of course, we have all these highs. These are highs for the well, it's not for the year actually. The high for the year came back here in the month of April, where the market reached a high level of 94.60. These highs highs in the month of June come in at the 94.36 level, and this comes in at 94.44. So those will be targets on the top side for the Aussie versus U.S. dollar. The New Zealand versus U.S. dollar. I'll make this a final currency pair, and our look here is trading near the, if not made new highs toward the end of the day here closing just near the high price that we saw in last month's at the 87.78 level. The close for yesterday's trade came in at 87.78, so right there at the high is where we closed the New Zealand versus U.S. dollar. This is what it looks like on the hourly chart. We moved up early in the Asian session and then kind of consolidated and made a late run to the upside here, so the bulls remain in control. Off the 5-minute chart, probably cleaner picture here for the pair because we moved up higher and then we did sideways. When the sideways momentum started to fade, we actually moved below the 100 and 200 bar moving average. Price probably should have gone lower through here, but we didn't get below the 38.2 to 50% retracement level of the move higher in trading here today. So of this move to the upside right here, the market couldn't get below that 38.2 to 50% retracement, and that led to some short covering, got above the 100 and 200 bar moving average. In this case, they're both converged, and that helped push the market to the upside and making new highs in the last half hour or so of trading in the New York session. Now we're down a little bit off of that level, testing the high close or high level that we saw in yesterday's trade, just right here at the around the 87.75 level, and as long as it stays above it and really the 100 and 200 bar moving average and the trend line at the 87.64, this 87.65, this is 87.67. Those three levels become our support levels now for the New Zealand versus U.S. dollar. As far as other economic releases go in the next 24 hours, we have Japan household spending for May coming out at 7:30 Eastern time. Estimate is minus 2.3. We have the CPI ex food and energy and year-on-year estimates at 2.2 and 2.3. Remember, this includes the sales tax increase, so that's hence why it's up a little bit higher than what you may be used to. Japan unemployment estimate 3.6. We also have Japan retail sales coming out at 750. Overnight we have the UK current account. We also have UK GDP, Canada RMPI and IPPI price indices, and then the University of Michigan's consumer sentiment ends the day at 9:55 tomorrow for the US. Wishing everyone good fortune in your trading. My name is Greg Michalowski, and we'll talk to you tomorrow. Bye-bye.